Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to go through a couple of trade ideas that I am monitoring at the moment. In terms of a quick market update though, before we begin, uh, it's been a bit of a choppy start to the week. In terms of US equities, they saw a bit of a rally on Monday, a bit of a relief rally after getting battered recently, but that's all being given back at the start of Tuesday's session because we have seen US bond yields across the curve pushing to new multi-year highs pretty much. You've got the 2-year approaching 4%, you've got the 10-year approaching 3.6%, 30-year also approaching 3.6%, all multi-year highs. You got the dollar strong as a result as well, and it's all as a result of jitters pretty much about central bank tightening. You got the Fed coming up on Wednesday. They're expected to do at least 75 basis points. Small chance they might go with a 100 basis point rate hike. You got the Bank of England on Thursday. You got other central banks as well, like you had the Riksbank, who just hiked interest rates by 1% or 100 basis points, which was bigger than expected. There's loads of emerging market central banks this week as well. There's also the Bank of Japan. They're not expected to change policy though, and we also had China, who didn't change their benchmark lending rate. That was during Tuesday's Asia Pacific session. But yeah, you've got all these concerns about global central banks tightening, but then you've also got concerns about slowing global growth. You recently had the World Bank and the IMF downgrading their global growth forecasts, and other major banks issuing more downbeat outlooks. FedEx last week talking about global macro headwinds. So things keeping equities on the back foot pretty much. Yields high and the dollar strong. That's pretty much where we are right now. But let's have a look at some of these sort of trade ideas that I'm thinking about. Now, the first one I want to talk about is euro dollar, which I've got on 1-day candlesticks here. You can see it continues to sort of stabilize in this parity area, which it's been for about a month. Still in this long-term downtrend, which has been in place since about, well, February actually. The reason for the recent stabilization is because you've had this rapid, basically, change in ECB monetary policy and expectations for ECB monetary policy. They've become a lot more hawkish. They did their 75 basis point rate hike last week. More big hikes are expected. We're now talking about an ECB interest rate that could peak at around 2.6, 2.7%. Just over a month ago, I don't know if we were even talking about above 2%. Now, this, of course, is still well below the Fed. I mean, we're talking about the Fed interest rate peaking around 4.5%. I'm just looking at the Fed funds futures here, around 4.5% next June. So they're still well behind the Fed in terms of monetary policy divergence. There's also the fact that even though people are getting more pessimistic on the US economic outlook, we're still talking about core inflation and a labor market in the US, which is very, very strong. Meanwhile, in the Eurozone, we're pretty much talking about how they're in a recession already and things could potentially get much, much worse this winter because of the energy crisis. And then layer on top of that, if you're also talking about generalized slowing global growth, well, then that is just generally a dollar positive through the safe haven avenue. So what I'm getting at here is I think that this downtrend in euro dollar is set to continue. I do think we're going to eventually head to this target level, which I've marked up on the chart here, around 0.96. Why have I targeted that area? Where its resistance turned support from 2001 to 2002. And the way I'm going to be looking to play this is looking potentially to sell rebounds towards 101, towards the 50-day moving average, which is around there, which you can see has been a nice level of resistance in recent months. Like Eurodollar has really struggled all the way back to March, the end of March, to hold above its 50-day moving average, and of course this trend line. Any rallies back to this area, I like to target back towards annual lows, with potentially the view to hold all the way to this target area that I've been talking about. Moving quickly on to dollar yen, you can see it's been trending aggressively higher recently. Dollar yen has a tight correlation with US bond yields because of rate differentials. Basically, Japanese bond yields are pretty much locked at zero thanks to the Bank of Japan's yield curve control policy. And you have got yields pushing higher this morning, multi-year highs, like I said. Dollar yen not pushing to multi-year highs, close to them, but not pushing to them. Why is that? Why have we stabilized in the last couple of days despite US yields continue to push higher? Well, it's all this chatter about intervention to stem the yen's decline from Bank of Japan and other Japanese government officials. Now, is that going to be able to stem the decline ultimately? I think not really, because the fundamentals are always going to win. Unless they go really, really, really big with their intervention, which, to be fair, they do have the firepower to do. I think potentially Fed this week going to be very, very hawkish in wake of recent inflation data. Even if they don't go 100 basis points, we've got new economic forecasts, we've got a new dot plot, we've got Fed Chair Powell appearing in the press conference again. Plenty of potential sources of hawkish surprise. Meanwhile, the Bank of Japan, I think, is going to be, dovish as ever, even if they do jawbone a little bit about yen weakness. So I think we could have this next push. Looking at dollar yen on the RSI, it's not oversold anymore, which means technically there's room for further buying. And I'm targeting this area 147 because that is a high from, I believe, 1998. Yes, it is from 1998. August 1998 to be precise. So that's what I'm looking for. Although, like I say, the bank, the Ministry of the Minister for Finance in Japan has said that they could intervene at any moment, and they're not going to say when they intervene. They're not going to confirm that they have intervened. They're going to keep it all very obscure, basically. So it is going to be a difficult instrument to trade, and it is potentially going to be very choppy, dollar yen. So just trade with caution there. Moving on to another asset class, the S&P 500. Already spoke about in this video. We're back under pressure this morning amid rising yields, amid central bank tightening jitters, and the broad concerns about the global growth outlook. Technically speaking, then, what's going on? Well, had this downtrend. Remember back here in mid-August, we also rejected the 200-day moving average, which has fallen a little bit to like the 4,200s. It's somewhere up here. So we're below that. We're below the 50-day moving average, and we're below the 21-day moving average. So momentum clearly negative. You had this slight uptrend, which for a time I was sort of quite optimistic about prior to that CPI, that horrible CPI data anyway, which caused that big drop on the 13th of September. Well, we now broken below that uptrend, meaning a break of this long-term pennant, which is very bearish. We've retested it and rejected it. Very, very bearish, and what you would expect from a sort of a technical standpoint. So I'm, sadly for the global investors like myself, and sadly for the equity bulls, I think we're headed to this 3,700 area here, the mid-July lows. That's my next target. Hawkish Fed, slowing global growth, concerns about all this stuff. I just don't see a near-term major turnaround unless we start, for whatever reason, revising lower these tightening expectations. But even, or maybe the signs of inflation that we get later this month or next month are a little bit less concerning than what we had last week. But otherwise, I think we're headed lower in the short term. Finally, WTI. It's been trending lower all the way since June. And as we talk about this worsening global growth outlook, as the dollar strengthens, as the outlook for global growth in oil demand basically worsens, even though the OPEC's now started to slowly cut output, you've also got Russian output falling still. You've also got the Iran deal, which isn't going through. But even despite these, you could say, bullish tailwinds, the macro is winning at the moment. And depending on how bad things get, I certainly think we're going to continue heading lower. And the way I would play oil is selling rallies back towards perhaps the 50-day moving average or back towards that 90 area. Unless things drastically change in terms of the global macro picture, which I don't see them doing in the near term, I think a push, like a definitive push back above $90 per barrel for front month WTI futures, it's going to be difficult. So I think we'll continue heading lower within this trend line. And in terms of chart support that you want to target, I mean, you could argue that this 75 area, there's a bit of, support, and then we went down and then we went up and then we got support again. That's potentially a good area to target. But the next major one is like 62 all the way down here, which, that might be a good long-term target. If we are talking about a global recession, including perhaps in the US, as well as the Eurozone and worsening growth in China and other places. Although, I'm not thinking about that just yet. I think that's perhaps a slightly premature call. But anyway, guys, hope you enjoyed this video. We're certainly going to be monitoring all these trade ideas and what happens with all these asset classes in the next couple of weeks. See you all in the next one.